Welcome to another episode of Buck Talk. I hope you got something good to drink. If you haven't subscribed, hit the subscribe button. New videos coming every day. Let's get into today's question. What's next after maxing our 401k? Probably a simple question, but you've searched and can't seem to figure out the answer. Currently, your wife and you are maxing out your 401k. You also make above the threshold to have Roth IRAs. After monthly bills and savings, you got about an extra $5K per month. That's pretty good. Stupidly, you've been putting it into the bank and not even into a high-yield savings account. Well, you don't need to feel that bad because high-yield savings accounts have not been yielding much for probably over a year now. So that's your first task. We'll try to figure out how to best invest it. What is the recommended option to do with the $5K each month? You've read about traditional IRAs and possible backdoor Roth, but still quite confused. The objective would be to grow this money for your retirement in the next 25 years. Okay. So the backdoor Roth that you've heard about is probably the best option. You can do that if you don't have any other traditional IRA type accounts that have any money in them right now. Sounds like you've only got your existing 401ks, but the backdoor, you'll only want to do that because of what's called the pro rata rule. If you don't have any money in traditional IRAs already, like if you had an old 401k and you rolled it over into a traditional IRA, that's going to mean you can't do the backdoor Roth until you do something with that. You could either convert that and pay tax, or you could roll that into the existing 401k. That would be an option. It sounds like you might not have any traditional IRAs, in which case it's a little complicated and it might confuse you if you do your own taxes. It might even confuse your tax preparer if they're pretty simple. But what you're going to do is make what's called a non-deductible traditional IRA contribution, and you and your wife can each do that. You can each put $6,000 in non-deductible, $7,000 if you're over 50, and you do not take a deduction for that. Anyone can do this. And then you turn around and you say, I would like to convert that to a Roth IRA. You don't have to pay any taxes on it because you didn't take a deduction in the first place. It seems like a loophole. It is a loophole. The IRS has said, you got to fix this law, Congress, if you want this to stop, because the way the rules are written, it's very clearly allowed. So that would be about $12,000 between the two of you. So, 2 months, 3 months of your savings. The rest of it, exactly like you said, you need a taxable brokerage account. So it would probably be a joint tenants account or a community property with rights survivorship account, depending on where you live, or an account in the name of your trust if you have a living trust. And then you can have that at Vanguard, Charles Schwab, Fidelity, wherever. And you can invest it just like your IRAs or your 401ks invested. You can use it for retirement. That's what people who are saving a lot of money do. First, you max out the retirement accounts to the extent you can. And if you got tons of extra cash flow, or if you just need liquidity, you invest in these outside, regular, taxable brokerage accounts. So that's what I'd be thinking about if I were you. Good luck.